You have your annual withdrawals column, which is the lifetime income rider, which we illustrated to be deferred for 5 years, turning on in year 6. And now we have this credited interest rate column, which is introducing the back-tested index crediting returns using the last 10 years, and they're just projecting that out forward-looking. And what we're going to notice here is that once that income turns on, because of the amount of cash flow being produced by that income rider, the index returns and the sequence of those index returns and the income rider drag from the fee, it starts to erode this account value. So you see it pretty much going down every year. And before you know it, in this case, it actually lasted a little longer than I anticipated. But at age 85, there's $0 going into the next year because of the account erosion. So in this case, if you lived a really long life, that enhanced income rider benefit may not be available. And all that time you were planning on it potentially being there. So that's something that we see in some cases. You have to understand that none of us have a crystal ball to know what the markets are going to do in the future. And we also don't know what the sequence of those market returns are going to be in the future. So this is just a simulation. This doesn't mean that this would happen. It could be the complete opposite. It could be way better. It could also be way worse. But what we do know is that if having an enhanced income benefit is important to you, you at least need to have a really good index crediting potential available from that annuity contract. And what I would prefer to do, and it's what I've been doing with our clients, is rather than putting all of the premium investment into one annuity, if we identify that they have a secondary objective for long-term care and they want that benefit, what we're doing is using a multi-annuity strategy where we'll use like one really good high income guarantee, and then we'll diversify and go pick another one. So for example, if they're doing $300,000, you could go buy 3 $100,000 annuities, and you're kind of piecemealing them together based on the objectives. All of them are going to offer guaranteed income, but what we're doing is mitigating the risk. If we're in just one product that doesn't have that enhanced income benefit guaranteed in the contract, we're mitigating that risk, and we're buying a couple annuities, at least one, but maybe 2 out of the 3 that have contractually guaranteed enhanced income benefits that even if the account value depletes to 0, we're going to, you still have that benefit available. So it takes all the risk out. It takes all the pressure off of the index crediting to continue to perform. And it gives you more peace of mind that we're, dialing in your objectives and right fitting the annuities and the overall strategies, to hit your primary objective and your secondary objective of long-term care.
Yeah, that's a great point. And I think one other element that may be considered if we're going down that path of what it would look like to have multiple annuities owned for the purpose of lifetime income is now by creating that structure of having several. Now you can also start them at different points to turn the income on at different points in time. So taking that approach can add a lot of value in different areas when we're looking at the annuities.
100%. And that is really key too, is like, optimizing the strategy. What we find is that there can be really far more optimal solutions when it comes to creating lifetime income. You don't have to put all your eggs in one annuity. At least the position, the amount of money you're wanting to position in. You don't have to put them in one. You can still, if you like one product and you love what it does and you love the way it grows the income, or maybe has an enhancement on the long-term care, if you like it, you can take that tranche of money, and instead of putting it all into one contract, you can break it out over several, and then you can leverage the guarantees in the income rider contract to defer longer if you only need some of the income out of the gate. So I actually have a client I'm working with on that right now. He's doing $750,000, and he only needs about $300,000 right now to service his current income need, and the other $450,000 we're deferring it out long term, 5 to 10 years. And because of the guarantees in the income rider contract, we're able to continue growing that income benefit pool using guarantees rather than, if he were to leave that money in the market and just hope that it does well, he doesn't have to now take that unnecessary risk. He can take advantage of those 8%, compounded roll-up rates and really have a lot of confidence that that income is going to be there, and he knows exactly how much it's going to grow to when he needs it.
Yeah. 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 So by looking at the right product, it can provide some extra value, really, and provide, uh, remove that uncertainty when that time comes with that long-term care, or like you had mentioned, maybe something that's an inflationary tool of starting that income down the road.
Exactly. So I think this would be a good time now to just to kind of tie it all together and show you how we would now look at the entire annuity marketplace using the same scenario that we typed into our calculator with a 60-year-old male, 58-year-old wife, joint life structure, $100,000 premium, deferring it out 5 years, and kind of see how we would now start to look at this, knowing that we have a framework to base our determination and our decisions on. So
Yeah.
I am going to open the software up and let me
Yeah.
know when you see it.
I can see it. Yeah. And just going back to why we utilize this tool, we had made reference that sometimes some clients come in, we talk to them, and they've been suggested one product, or they've met with 3 advisors and they were suggested 3 different products. Well, that doesn't sound like a right fit. Why don't we just take a look at the marketplace together and find out what fits your needs, as opposed to me telling you there's one answer?
Exactly. And so we're going to look at this, and as we just now have uncovered, and this is kind of a scenario that we run into quite a bit, where someone was pitched a product and that product wasn't actually the best one available, just from a primary objective perspective, just looking at it from a lifetime income perspective. The reason that we're able to do what we do is because we are an independent annuity advisory firm. We truly care about our clients' best interest, and we're required by law to care about them, not just from a moral and ethical perspective. We also are legally bound to it. Our headquarters is in Florida. It's one of the early adopters of the annuity best interest standard, and we're proud of that. And we've been that way before that regulation came into existence.